Hey everyone, welcome. Have you ever actually stopped to think about the fact that for every single dollar of profit made by a winner in the market, there's got to be another trader on the exact opposite side losing that exact same dollar? It's wild to think about, but the market is, in a lot of ways, a totally zero-sum environment. So today, we're going to unpack exactly what separates the consistent winners from the consistent losers. We're diving deep to explore the two undeniable pillars of trading: strategy and risk. To really anchor everything we're talking about today, there's this incredible quote by Mark Douglas from his legendary book, The Disciplined Trader. He literally says, "Successful trading is 80% money management and 20% strategy." Just think about that for a second. Most novice traders spend all their time obsessing over that 20%, right? Finding the absolute perfect entry, the flawless technical indicator. But the actual winners, they're absolute masters of the 80%. The money management, and the risk control. So, in this explainer, we're going to break down both sides of this equation so you can start trading with a real, quantifiable edge.
All right, so here is our roadmap for today. We'll start off with the 80-20 trading rule, and then move on to navigating with pivot points, which is going to form our strategy base. After that, we'll shift straight from those technical market setups into the real math of protecting your capital. That means covering systematic versus unsystematic risk, the power of diversification, and finally, calculating your expected return.
Section 1, the 80-20 trading rule. Okay, let's dive right into this.
To tackle the 20% strategy part of the equation, intraday traders rely heavily on these ultimate navigational aids, and they're called pivot points. Basically, these are technical indicators calculated super simply from the high, low, and closing prices of the previous trading session. You can think of them like a real-time GPS for market sentiment. By establishing a primary pivot line and its surrounding support and resistance levels, they pinpoint exactly where buyers or sellers are going to cluster together. So, if prices are rising above that primary pivot, sentiment is bullish. If they drop below, we're looking at a bearish market.
Now, what's really interesting here is that not all pivot points are created equal. Traders actually pick and choose different flavors based entirely on their own aggression and risk tolerance. Like the classic pivot, that gives you a nice grounded, balanced view, which is perfect for conservative traders. Then you have woodies, which heavily weights the closing price. But hey, if you're an aggressive trader, the kind looking for dynamic ranges and really fast profit signals, you'd probably lean towards the Camarilla because it produces a much higher number of pivot levels. We've also got Fibonacci, which integrates classic retracement math, and CPR, or central pivot range, which gives range-bound traders a defined zone of support rather than just one hard line. Honestly, it's all about aligning the tool perfectly with your personal style.
So how do we actually use these tools in live, breathing markets? Well, there are a couple of core approaches. The bound strategy is essentially range trading. You buy near support 1, or S1, and sell near resistance 1, or R1. On the flip side, the breakout strategy is for when the price just violently punches right through R1 on heavy volume. Basically, you just ride the trend. But, and this is super important, you shouldn't use a pivot point in total isolation. You really want synergy. You combine your pivots with indicators like the MACD or the RSI just to double-check that market momentum. And most importantly, and this bridges us perfectly to our next topic, you absolutely need strict protection. Always, always place a stop loss just below S1 if you're buying or right above R1 if you're selling. That right there, that is the crucial 20% of our market strategy.
Section 3, Systematic the Unsystematic Risk.
All right, let's shift gears over to the 80% of Mark Douglas's rule, the money management side. Because here's the harsh reality. The best pivot point strategy in the world absolutely cannot save you from unseen fundamental market risks. We really need to contrast the two types of risk you face the exact second you buy a stock. First up, unsystematic risk. This is internal, company-specific danger. Think things like management misconduct, declining business margins, or just sudden new competition. But because it's completely isolated to just one company, it can be diversified away. Then, on the other hand, we have systematic risk. This one is external and market-wide: GDP dropping, crazy inflation, or sudden interest rate hikes. You literally cannot diversify this away because it drags the entire market down with it. It has to be hedged. Honestly, think of hedging against systematic risk like carrying an umbrella on a cloudy day. The second it starts pouring on the whole market, you just snap that umbrella open to cover your portfolio.
To really drive home just how dangerous unsystematic risk can be, let me tell you this absolutely spine-chilling anecdote from the Indian markets. The Satyam Computers crash from January 7, 2009. For literal decades, Satyam had been cooking their books, inflating numbers, and completely mishandling funds through just severe management misconduct.
And it all catastrophically unraveled when the chairman, Ramalinga Raju, released a bold confession letter owning up to the heinous financial crime. Udyan Mukherjee was actually reading this explosive confession live on TV while the stock was just plunging like a stone off a cliff. But here is the critical takeaway. While Satyam's stock was getting totally decimated, the broader market indices, like the Sensex and Nifty, they barely reacted at all. The drop was completely uncoupled from the rest of the market. That right there is the ultimate, terrifying example of an isolated, unsystematic risk.
Which brings us to Section 4, the power of diversification. So this naturally begs the question, how do we mathematically protect ourselves from a massive, company-specific disaster like Satyam? If a seemingly strong stock can basically go to zero in a single day, how do we survive? And this brilliantly illustrates the exact mathematical solution. If we map this out, with risk on the vertical axis and the number of stocks in a portfolio on the horizontal axis, notice how that unsystematic risk just plummets aggressively as you add more stocks. I mean, if you hold just one stock, you bear 100% of its internal risk. But as you add a second, a fifth, or a 10th stock across completely different sectors, the localized damage of any single company failing gets heavily diluted.
But here's the catch. You can't just keep adding stocks forever and expect your risk to magically hit zero. Enter the 21 stock rule. Research actually shows that holding up to 21 differently allocated stocks provides the maximum necessary diversification to completely flatline your unsystematic risk. You can literally see the curve flatten out right at that spot. Anything beyond 20 or 21 stocks just gives you diminishing returns. So what's left over after that point? That is purely your market-wide systematic risk, which, like we talked about, requires that metaphorical umbrella to hedge against.
Section 5. Calculating your expected return.
So once we have our 20% strategy locked in with our pivot points and our diversified portfolio built out to manage those risks, we actually have to do the math. We need to calculate the actual mathematical reality of our portfolio management. So I want to pose this direct question to you right now. How much will your portfolio actually make? I know it sounds super simple, right? But setting a realistic expected return is literally the foundational number we need for all of our subsequent risk and variance calculations.
Here is the expected return formula for a portfolio. It's calculated as the weight of your first investment multiplied by its expected return, plus the weight of your second investment times its return, and so on. Let's make this highly practical. Let's say you have a capital of $50,000. You put $25,000, so a 50% weight, into Infosys, and you're expecting a 20% return. You put the remaining $25,000, another 50% weight, into Reliance Industries, expecting a 15% return. So your portfolio's expected return is 50% of 20, which is 10, plus 50% of 15, which is 7.5. Add those up, and your overall expected return is 17.5%. But listen, here is the absolute golden rule you must remember. This is a probabilistic expectation. It is never a guaranteed return.
So the crucial point is understanding just how wildly your actual returns might swing away from that 17.5% expectation over time. And that is exactly where variance comes in. Think of variance like a measure of turbulence, how much a stock's daily return bounces away from its average. A massive variance means your returns are violently spiking and crashing. Calculating this spread from the average is exactly how we actively monitor the daily danger levels of our portfolio.
All right, so we've covered the 20% strategy and the 80% money management. So I'm going to leave you with this final provocative thought to really ponder. Is your portfolio built on a mathematical edge, or is it just built on blind hope? Have you actually calculated your expected returns and your portfolio's variance to ensure you can survive the next market crash? Look, the tools are all right here. The math absolutely works. It's time to marry your pivot point strategies with some hard-nosed risk management. Reevaluate your trades, respect the risks, and start managing your capital exactly like the professionals do. Thanks so much for joining me on this explainer, and keep learning.